The Great Decoupling, how the housing market broke forever and how it's actually much worse than you even imagined, and a sign of a massive structural fracture in the banking system. It sure looks like the American dream is slipping away forever, but why? In this video, we're diving deep into the Great Decoupling, how the real estate market completely broke along with the banking system writ large. We'll examine how everything completely fractured and why the housing market isn't behaving as it used to, with many surprising forces at play. We'll unpack the charts, expose the hidden forces propping up prices, and reveal what's really driving the housing market now, and hint it's not what it used to be. So this is building off the video that we did on Richard Werner and his concept of private bank credit creation. Remember, private banks are able to print dollars. They are able to print money. When they extend a loan, they are printing that out of thin air. They are not doing it from deposits. They are not doing it from reserves, fractional. They are not doing it on a fractional reserve basis from reserves, nor deposits. They are creating those dollars out of thin air. This has been proven. We did a whole video on it. I will link it at the end. But suffice to say, for the rest of this video, remember, private bank credit creation is critical to understanding some of the forces we're going to look at. So here we see real estate loans on a nominal basis from all commercial banks. 5.68 trillion. Sounds great, and it looks exponential. But what we need to look at is the rate of change of the red line. And what I want to point out, so this dotted line down here is 0%, and then this is 5, 10, 15, and 20% year over year growth in real estate loans. And again, post 2008, everything completely broke in terms of the rate of growth of the red line of real estate loans. We can see that here, for example, in 1973, real estate loans were growing at 22% on a year over year basis. Here in 1978 at the peak, they were growing at 20%. And then here again in 87, they were growing at 20%. Here in 2000, they were growing at 17, 18%. So the lowest that this growth rate would ever get is like 4%. Well, post 2008, outside of 2022, where we had a brief period of strong growth in real estate loans, post 2008, something clearly broke down. And we will look at this in much more depth coming up. Why does this matter? Well, real estate loans, the rate of change of real estate credit creation by the private banks, is highly correlated, or at least it used to be highly correlated, to the average home price rate of change. So in red, we're looking at the rate of change of home prices. And then in white, again, is the rate of change of those real estate loans, currently only at an anemic 1.27% yearly growth rate. Here is the average home price offset by 10 months because there is a bit of a delay before the real estate credit creation gets reflected in prices. So here we're looking at real estate loans, but instead of looking on a nominal basis, we are adjusting for this exponential by looking at it in logarithmic form. And this trend here, you can see there was a clear break in 2008. Now, it is not just real estate loans. We have done other videos in our Silent Depression series showing how this was also real personal income. This was real GDP. A lot of things broke from their 50, 60-year trend in 2008 and have not recovered. I would also link that video at the end. Recommend that if you have not seen it already. But real estate loans did not keep up with their growth rate. This is going all the way back to the late 1940s. This trend rate of growth continued from the 1940s all the way up until 2008. Then something broke. Well, if we were to total up the gap, if we had kept pace with that growth rate, there would be $15 trillion more in terms of real estate loans than there are currently. Now, despite this, we actually had, here's an affordability index of a single family home. We take the inflation adjusted home price, and then we take the real purchasing power of personal income and use that as the denominator. What we can see is home prices, or the affordability, actually got worse. So real estate loans, which used to drive home prices, as we can see here, real estate loans flatlined, basically, completely anemic, and yet we broke to the upside of this rising resistance trend line. We actually broke above the resistance. You can see that before it would hit that resistance, get more affordable, hit that resistance, get more affordable. Well, this time we just broke above and continued ever higher. So why is this? What is going on? Well, here we're looking at the rate of change of real estate loans relative to real GDP. What I want to show, ISM PMIs is a business cycle indicator. We offset the ISM by 3 months. What I want to show, again, very, very tight correlation from the 1940s all the way through until arguably you can say sometime in the mid to late 90s, kind of started to break, and then post 2008 it really broke down. So what is going on here? What really happened in 2008? Well, first we have to go back before 2008 to the dot-com bubble, where Paul Krugman actually called for a housing bubble on purpose. To fight the recession, this is a quote, to fight the recession, the Fed needs soaring household spending to offset moribund business investment. So Alan Greenspan, the chairman of the Fed at the time, needs to create a housing bubble to replace the NASDAQ bubble. This is well documented. You can find that if you just search on the internet. They called for a housing bubble because dot-com was becoming so destructive. The equity bubble pop was becoming so destructive that they actively tried to blow a housing bubble that led eventually to the GFC. Well, here we're taking a look at total loans and leases. So not just real estate loans, total loans and leases from all commercial banks. And what do you know? The trend broke in 2008 as well. We can see that the missed output of loans and leases, private credit creation from the banks, is $13.8 trillion. If we had kept pace with the rate of growth from the 60s all the way through to the GFC, if we had kept pace with that rate of growth, we would have $13.8 trillion more lending in the economy. Now, down here, we have the rate of change of total loans and leases. And then again, those ISM PMIs offset by 22 weeks. So again, it's really critical for people to understand that private bank credit creation is so critically important for economic activity writ large. That's what we're looking at with the ISM PMIs. So here we're looking at, in white, real estate loans divided by the average sales price multiplied by the mortgage rate. So this shows the effect that mortgage rates are having on the current real estate lending market. Then here in red, we're looking at real estate loans relative to just the average sales price. And again, both of them show that post 2008, they are actually down. So real estate loans used to grow faster than the average sales price of the average home, as we can see here from the 1970s all the way through to 2008. But it has actually declined. So real estate loans are growing at a slower pace than the average sales price. And we'll take a look at more charts showing this and why in a second. If you factor in the mortgage rate, it's even worse. Factoring in the mortgage rate, you can see that lending activity is back to 2007 levels. So here's part of that kind of rate story, interest rate story. Here's the average annual interest rate, interest expense on the average home. And then in red, the 30-year mortgage rate. Well, in the past 5 years, the average annual interest on a new home purchase 3x'd. It went from about $9,000 to $27,000. And this chart goes all the way back to the early 70s. This is despite the 30-year mortgage rate not really making that much of a move higher. We can see that because once you couple it with the home prices appreciation, once you couple the two together, it is really unaffordable. This average annual interest expense on the average house went from costing, $7, $8, $9, $10,000 this entire period of time and went to $27,000 of just interest per year. So here we're looking at some of the breakdown that's going on in the housing market that a lot of housing bears and housing analysts writ large aren't seeming to understand. And that's what this video is hoping to address. So here we have the single family home price in yellow and then the average mortgage size. I've shown this chart in many of our videos. We can see that over the past 2-3 years, the average mortgage size has actually declined from about $457,000 to just $372,000. You can see that this has never happened in conjunction with rising single-family home prices. Here, during this period of time leading into the GFC, they flatlined, the average mortgage size flatlined, but it did not decline nearly as notably as we're seeing here recently over the past 2-3 years. And yet that is despite the single family home price going up. Well, here in white is the rate of change, the annual rate of change for the average mortgage size. And it's looking at the 12-month period. What we can see is that the average mortgage size that I just noted in red is declining at 15% on a year-over-year basis. The average mortgage size, let me say that again, is declining at 15% on a year-over-year basis. Now, we can see that it's only hit that period of time once, February 2009, the height of the GFC. So what is going on here? So here's the unemployment rate and the fiscal deficit as a share of GDP. Remember, this is the difference between what the government spends and what it collects in tax revenue. We can see that from .com, here I'm starting in 2000, we were running about a 1% of GDP fiscal surplus, and now we are running it's actually 7% deficit. So as a share of GDP, the gap, the difference between what the government's spending and what it's collecting in tax revenue is 7% of GDP. And this chart goes all the way back to the early 1950s. We can see how historic this is. Well, this is despite an unemployment rate that is basically flat. If you go back to 2000, the unemployment rate is just what it was in 2000. Yet our deficit as a share of GDP has increased by 8% as a share of GDP. This is what's known as a pro-cyclical deficit. We are running these utterly insane deficits when unemployment and general economic activity is not bad. Normally, it's usual to run a deficit. You will see the deficit increase as a share of GDP during a recession. Unemployment is spiking, therefore the deficit increases, and eventually unemployment starts to come down. The economy gets jump started and recovers, and that deficit comes down. Well, that is not what we're seeing for the past 25 years. The government is stepping in. Again, going back to something started to break with private bank credit creation in the mid 90s, late 90s, certainly by 2000 and 2008. Something has to be stepping in. Well, to some degree, it is the federal government increasing the deficit as a share of GDP by 8% in just 20 years. So here is another a chart that reflects this structural fundamental shift in the structure of the U.S. economy and the banking system and the financial system. Here we're taking M2 money supply, dividing it by M0. Remember, M2 is broad money. That includes, is a much more broad measure of the money supply. M0 is a very narrow measure, only measuring currency and bank reserves, which are created by the Federal Reserve. What we can see is that M2 money growth from the early 60s all the way through up until the mid 80s, M2 money supply growth, the broad money fueled by private bank credit creation, outpaced government money. You can think currency plus bank reserves created by the Fed. And then this started to decline into the mid-90s. There was a notable leg lower here after the 1990 long-term capital management blow up and the recession, the short recession, started to decline there, but then it kind of stabilized, and it was stabilizing at levels seen in the 1970s. No big deal. But then what happened? 2008. And what we saw is a radical structural shift in who is creating our money. So we went from private bank credit creation, which was driving real GDP, the business cycle, home prices, and the like. We went from that to the government printing money. This M0 money supply, remember, you can think of as government money. So here's another way of looking at that. We're just inverting it. Here we're looking at M0 divided by M2. And what this shows is that government money, or M0, radically exploded higher, much at a faster rate than the M2 money supply, or that broad money supply that includes much more private bank credit creation. We can see that M0, the government money, was actually increasing at a slower rate all the way up until the mid-80s. And again, there was somewhat of a stabilization here, but really 2008 came around and government money exploded so much higher than M2 money that we get this particular graph that we're looking at here. And then finally, it was not just government money. Here is debt held by the Fed as a share of GDP. And here we can see that debt held by the Fed as a share of GDP from the early 70s all the way through up until 2008 was about 4 or 5%. Well, it is 15% now. So again, who is stepping in to fill the void, the crushing void of private bank credit creation, which has clearly stepped away? Well, the fiscal deficit, the government, and the Fed. Here we're looking at the Fed filling some of that hole. This goes to our whole silent depression framework. Here is mortgage-backed securities, another great example of the Fed stepping in to kind of prop everything up. Here you can see mortgage-backed securities held by the Fed, currently $2 trillion. And then in blue, we're looking at the rate of change of mortgage-backed security holdings. What I want to point out, I put some arrows here. We are in negative growth, right? The Fed is engaged in quantitative tightening. So their mortgage-backed securities have been shrinking at 8.57%. But look at the difference in time between when this goes negative to when it goes positive. It's about 2 years. It's about 600 days, 665, 700. Well, we are currently at 917 days. I think that's interesting. It doesn't mean that we have to go back into QE, but I do think that is a bit of an interesting pattern. Now, there's also the story of the K-shaped economy. So we established that private bank credit creation fell off. We established that the government, via the fiscal deficit and the Fed, printing bank reserves out of thin air to buy things like federal debt or mortgage-backed securities, they stepped in. But we also have to look at the K-shaped economy for why the average mortgage size is declining despite the single-family home price going up. Well, here is a great way to visualize that. This is the mean or the average family income divided by the median family income. So we can see the degree to which the upper income earners are getting richer at a radically faster rate than the median or the middle in terms of income. And this really took a leg lower again in that kind of mid to late 80s. Here we're looking at a chart that I did from, I think, another video. This is annual civilian wages divided by total homeowner equity. And civilian wages on a total aggregate basis for the entire U.S. economy have lagged home equity equity creation by 70% since 1965. Put another way, homeowner equity has outpaced total civilian wages by 243% going back to the early 60s. So again, K-shaped economy, asset holders versus everyone else. That is what that chart was illustrating. Here's the net worth of the top 1% as a share of GDP versus the total annual civilian wages as a share of GDP. And unfortunately, this data only goes back to the early 90s, but we can see that what this means is the net worth of the top 1% has been growing, but it's been growing faster even than GDP. That is why the red line is going up with a relative chart. Well, the opposite is true here. GDP has been growing faster than the annual civilian wages here. So the upper leg of the K is doing obscenely well. Now, there's another factor we got to look at. So I've pointed this out multiple times, and I always harp on the current account and the trade deficit. This is why. Here's from a Wikipedia article on the 2008 GFC. The Economist wrote in July 2012 that the inflow of investment dollars required to fund the U.S. trade deficit was a major cause of the housing bubble and financial crisis. They mentioned that it hit 6% of GDP in 2006. Remember, the other side of a current account deficit or trade deficit is a capital account, capital and financial account surplus. So that is what we're looking at in white. If you invert this white line, you would get the current account, right? We understand that that is a pretty insane $150 billion per month current account deficit. Well, the other side of that is $150 billion flowing into financial assets here in the US. So here we're looking at that the capital and financial account surplus, about $150 billion per month, $450 billion per quarter, and the correlation that it has to the net worth of the top 1% as a share of GDP. Again, there was a divergence here. This is when the Fed was engaged in quantitative easing 2 and 3, where they were printing bank reserves out of thin air to buy assets. It was very, very helpful for the net worth of the top 1% who own the vast majority of the assets. So here, I wrote a post August 10th, so I guess about 2 weeks ago, about this dynamic of the current account and the effect that the other side of it has. And so you can actually find data on what they call foreign direct investment in real estate. The BEA, who tracks the current account and the corresponding capital and financial account, the BEA puts this data out, and you can find it in the video that I did here or in this thread that I did on X. And I want to point out that foreign direct investment in real estate from foreigners, that is one of the ways that we balance a $150 billion per month current account deficit. Is $150 billion comes into financial assets, including real estate. Well, this shows the amount of actual specific real estate investment. And since over the past 14 years, the average single family home price was over that time period was about 350,000. The total sum of FDI was $140 billion. On a cumulative basis, this $140 billion could have purchased 400,000 single family homes. And that doesn't even include portfolio investment in real estate investment trusts and mortgage-backed securities, which get recorded under a different category, which is not tracked and it's not disaggregated. Direct real estate purchases are, I totaled those numbers up, it represents 500,000 almost single family homes. And the other thing I want to point out here, it's not just the net worth of the top 1%. Here is the inflation adjusted home price. And again, it is very, very highly correlated to the current account or the inverted current account. And the reason is that this requires a corresponding amount of capital to flow into financial assets here in the US. So this purple line is home affordability. As the trade deficit gets worse, as the current account gets worse, more and more money must flow into US financial assets. One of those, as we just established, is real estate. Therefore, this pushes the affordability, even on an inflation-adjusted basis, higher. And again, there's a divergence. This was QE2, QE3. The Fed printed an obscene amount of bank reserves to buy an obscene amount of mortgage-backed securities, which increased the home price more than the current account or the capital account would indicate. Now, finally, to wrap up here, I want to go through the home builders. So XHB is an ETF that tracks the home builders. And then down here in blue, we have the rate of change over a 12-month period of the home builder index. What I want to point out is we are starting to really break out in terms, or the home builders are growing at 24% over the past 12 months. Excuse me, this is on a weekly chart, so this would be over the past 12 weeks. Here, I will put it on a monthly chart. We can see that rate of change is just barely going positive. But over a shorter time period, we can see the rate of change recently in the home builder stocks is approaching 25% over the past 15 weeks, 12 weeks. The home builders are really starting to make a move. And this is because of lower rates. So here we're looking at XHB, or the home builders, divided by SPX. So the degree to which they have underperformed the S&P 500. And again, the same chart, or the same story is at play here. The home builders are really starting to outperform the S&P. Now, they have been underperforming going back to September 2024. They've been had this significant pullback relative to the SPX, but they are starting to break out of this downtrend and head higher. Again, over a 12-week period, home builders are up 25%, and that is due to lower rates. So finally, to finish up here we're going to look at the H8 report. This is a disaggregated credit creation report that the Fed puts out. And this shows various different ways of looking at private credit creation. Here, for example, this top line represents overall bank credit. And what I want to show is when it comes to real estate. So here we're going to look at real estate loans. There's a couple things to point out here. So in July of 2025, they grew at 1%. Now, remember what they used to grow at. We're 7, 8, 9, 10, 12, 13, 14%. So relative to historical averages, still very low, but they are growing at 1%. In June, they grew at 1.3%. This is an annual rate. In May, they were growing at 2.2%. In April, about 2% as well. For the second quarter of 2025, look at the quarters. So I'm going to highlight from 2024 quarter one up until 2025 quarter two, which is where we are now. So 2024 quarter one, they were growing at 3.8. Quarter two of 24, they were growing at 2.4, so slowing down. And then by quarter three of 24, they were only growing at 0.6%. But look at what has happened recently. This private credit creation by the private banks has started to pick up again, going from 0.6% annual growth rate in the third quarter of 24 to now 2% annual growth rate. And again, the ISM is indicating that we might be starting to enter kind of a higher nominal growth environment, an acceleration of the business cycle. Well, you would expect, going back to the prior charts that we were looking at, which I'll show one last time, if the business cycle, if real GDP and kind of the overall economy is starting to pick up again, you would expect real estate loans to start to pick up again. And so we know that that'll drive prices higher. This goes to the kind of my general thesis that real estate is probably not going to crash. If anything, it's probably going to go up in terms of price. Now, there's one final thing that I want to point out, which is here. All cash buyers in 2024 represented a third of US sales in the single family home market. Foreign buyers, which we covered with the current account and the correlation to affordability, foreign buyers represented 2% of US sales in 2024. Now, you combine the two of those, and that is basically 35% of single family home purchases were done either by a foreign entity, which again, mechanically a result of running a trade deficit, or it was an all cash offer. So again, a lot of people are looking at the housing market all wrong. It appears with the ISM starting to pick up again, it appears that we could expect more real estate lending growth. And while that real estate lending growth is anemic compared to what it used to be over the past 70 years, if this starts to accelerate, you will see a corresponding increase in demand, because kind of by definition, that is what that represents, and therefore higher prices. And if we are entering a higher inflation environment, again, this is beneficial if you own a home, because your home is a levered exposure to currency debasement, goes optically up. It's an optical illusion as the price is increasing. It is just due to more monetary units being created. So there's a lot of things wrong with the single family home market, but again, it is indicative of a structural change that happened post 2008 when it comes to the way that our money, the way that our monetary system is functioning. We could see this with the deficit and the government, the federal government running these utterly insane fiscal deficits to fill the gap. We can see it. The Fed is printing bank reserves out of thin air, now owns 15% of the total U.S. government debt as a share of GDP, 15% when it used to be 4 or 5%. It was even as high as 24%, right? We saw the M0 versus M2. Government money, official government money had to step in to fill the gap. So there's a number of things that structurally changed, including the Fed and their asset purchases on their balance sheet. There's so many things that changed, whether it's wealth inequality, the K-shaped economy, the average outperforming the median. There's a lot of things at play here, and the housing market is not operating the way it used to. So those that are trying to call for housing crashes based on old metrics that don't understand these dynamics, I think are fundamentally missing the bigger picture. So anyways, hopefully that was helpful. A good addition to the private bank credit creation video that we did. This is going to be a series. We're going to continue to look at it. Richard Werner was certainly on to something. It is supported by all of the evidence that I've looked at and worth more of an exploration. So hopefully this video was helpful in that regard, and hopefully explaining why the housing market is functioning in a totally bizarre sort of way. I mean, we have, for the first time in history, we have the average mortgage size declining despite the average home price going up. This has never happened in history, going all the way back. This chart the data goes back to the early 90s. So a lot of things are fundamentally different than they ever used to be. And it's a result of deeper structural changes in the economy that we will continue to explore. So anyways, hopefully that was helpful, and I will catch you in the next one.